All right, recording now. All right. Do you see me? Does everybody see me on the screen? I see a student, but what do you guys see?
No, you in the PowerPoint?
Am I on the PowerPoint? Okay, because I see you guys. All right, which is great, but if I'm recording, I want it to be not be you guys. Okay, so we're looking at accounts receivable, and we're going to delve a little deeper in it today. And on Friday, we talked about how we have to estimate bad debts. Okay, so at the top of page 14, we said, and you can see it on the top of page 14, we said a company after its very first year in business has $75,000 in accounts receivable. Okay, so that means how many customers do they have? What does that mean? Any guesses?
What was the question?
They have $75,000 in accounts receivable. So what does that mean in terms of number of customers that they have? Can you make any speculation on that? You don't know the answer, but can you speculate?
I mean, it depends on what the business is. If they're dealing in large account purchases, or if it's a bunch of smaller account purchases, it's hard to tell.
What statement can you make, Bryce, without a doubt, how many customers they have?
They have at least one.
They have at least one, right? And we don't know. You're absolutely right. They could be doing small dollar transactions. They could be having 7,500 customers, or they could have one. But the point being is they've sent at least one customer a bill for services provided or products provided. And that customer has 30 days to pay, and they haven't paid yet as of December 31st. The fact that they're estimating their bad debt expense tells me that if it were only one transaction, one customer, they wouldn't estimate any, or they'd estimate it all. So they must have a lot of customers to have kind of a lower amount of bad debt estimate. Okay, when a company estimates bad debts, they use the allowance method. The direct write-off method is not allowed for large companies. And so this is the journal entry. You made it a couple days ago. So they debit bad debt expense and they credit allowance for doubtful accounts. And the dollar amount in this particular case is equal to their estimate of 6,000. The dollar amount of 6,000 in the journal entry is equal to their estimate of 6,000 in this instance. And the reason for that is because it's their first year of business and their opening balance in the allowance for doubtful accounts is 0. Okay, and I'm going to go into that in a few minutes. Okay, so that was on page 14. We talked about how accounts receivable is presented on the balance sheet. They can either list it separately, and then this 69,000 is accounts receivable net realizable value, or they can show it this way where they see accounts receivable net of 6,000. All right, so this is the more common way that I've seen. All right, so let's move forward. And we talked about writing off a bad debt. We debit allowance for doubtful accounts, which is a contra asset, and we credit accounts receivable. We get it out of accounts receivable and we dip into our allowance for that. Okay. We talked about on Friday how it doesn't impact the net realizable value. Both of these accounts do go down, but because we already recognize the estimate for bad debts in that first journal entry with $6,000, we don't have to impact our balance sheet at all because we've already reserved for this moment if there's a bad debt. All right. Now on page 15, we talked about how, what if that customer turns around and says, I'm here, I'm sorry, I'm going to pay you that old invoice. You reverse the write-off, debit AR, credit ADA, 750, and you record the collection the way you would for any other customer, debit cash, credit accounts receivable. Okay. All right. So what I want to do today is talk about how we estimate bad debts. And there are two popular methods. And if you look at the top of page 16 in your course pack, so turn to page, go with me to page 16 in your course pack. We're gonna do some calculations. Oh, I can't spell, oh well, too bad. Page 16 in your course pack. And we know how to do the journal entries. We did that at the top of page 14 when we estimate bad debts, debit bad debt expense, credit allowance for doubtful accounts. Now we have to delve deeper and say, how the heck did we estimate that? And there's a couple methods, okay. And again, we use the allowance method, and because it's better matching. So the allowance method has two sub methods. One is percent of accounts receivable, and the second one is percent of sales. And this is at the top of page 16. Both methods are acceptable. Both involve research of actual trends in the company's own business. Do your customers pay? What historically, how many of them have defaulted? What percent of them have defaulted, et cetera? Okay. But because one method takes a percent of accounts receivable, that's called the balance sheet method because it's on accounts receivable. The other method takes a percent of sales, and it's called an income statement method. So percent of sales method is not in your book. And I put that in your course packet. It's not in your book. It's a very simple method. You take a percent of sales and you book the entry, but it's not covered in your book. It's only covered in my PowerPoint slides and in the course pack. And I have used both methods in practice when I worked in credit and collections. Okay. All right. So let's do the percent of accounts receivable aging method first. So look at the middle of the page on page 16. A company gets a report and they look at their own history. And then the piece that I left out on here is they also look at the economy. And if the economy is going into a recession, that'll affect how much they estimate. So if a company's going into a recession, they're going to estimate a higher number of their accounts receivables will not be collected. Okay. So most software will prepare something called an aging schedule, a report of accounts receivable. So so let's look at this first one here in your course pack. So Garlic Jim's, a company has, which is, I think they're no more. They used to be in Bellevue. Great pizza, but I think they went bankrupt, sadly. Perhaps they had too many accounts receivable. But Garlic Jim's has 620,000 in accounts receivable. Most invoices are current. That means that, let's say it is the month of December and it's December 31st. That means most of the invoices that their customers owe them happened in December. But some invoices are old. That means they have not been paid on time. They are what we call past due. Okay, so you have this in your course pack. So let's walk through this. This method requires an in-depth analysis of accounts receivable, invoice by invoice. All I'm showing you here is the total line. Each invoice has to show up in one of these columns: total, current, over 30, over 60, over 90. The total is the total of all of these. So each invoice has to show up in one of these, in this case, 4 columns. And then you add them all up and it adds up to the balance in the T account, accounts receivable. So so 454,000 invoices occurred in the same month of the report. 102,000 invoices were billed in the prior month. So they're over 30 days. They're 1 to 30 days, okay? Past due, okay? I'm sorry, let me rephrase that. Current means they're in the current month. So let's say the current month is December. So the oldest it could be is 30 days old. At the point it goes to 31 days old, it's now in the next, what we call column or bucket. So these are starting to become past due. They're not really urgent yet, but they're starting. These invoices that add up to 30,000, now they're getting really old. They're like 60 days from invoice date. And then the over 90 are really, really old. Okay. So Garlic Jim says, we're in a pretty good position, but we do have some old invoices here, okay? So the question is, how do they use this report to come up with an estimate? Well, in the aging method, they assign percentages to each of these buckets, as you will. So the current bucket, based on their history, and we don't know their history, but based on their history, they're going to say 2% of the current typically ends up being uncollectible. But the older they get, the percentage grows. Okay. So when you do these problems, or you see these problems in your course pack or your homework, you're going to see that these don't go down. They just get higher and higher and higher. So the older an invoice is, the less likely it is to be collected. And think about that in your personal life. You go out to lunch, somebody borrows 10, 20 bucks from you. I'll pay you back next week. Next week comes and goes. And slowly it becomes a month, 2 months. You know, you're not probably going to see that money. Likely. They may surprise you,
Real
but
quick,
yes.
isn't that illegal just not to pay it? You know what I mean?
I do. What do you think?
Like, if they owe me money and we made the transaction, don't they have to pay? Aren't you going to see that money one way or another?
Legally, you are correct. And that's when people go to like small claims court and say, hey, they need to pay us money. Sometimes if they win, and that costs money, right? So let's say somebody owes a company $700 and they go to court and the judge says, you must pay this money. And the person says, well, I have no money. So then what do you do? So you've spent money on lawyers, you've spent money on taking a day off and going to court. So yes, you can go after these people. It can certainly affect your credit rating, but it depends on the dollar amount as to whether you're going to do it. The company's going to choose to do it or not. But legally, yes. And of course, the company's going to complain and it's going to go out to those credit Equifax and all those places that give you a credit score. Who was it on Friday was talking about credit score? Was that Micah? So something about if you want a credit score of at least, I think 800 was like the gold standard of credit scores. All right. So here we have, but in the meantime, a company has to plan their cash, right? They have to figure out, am I going to get cash or not? And they also have to be realistic. And so you can see on page 16, they estimate what their bad debt should be. And so then in the current column, 2% is 9,080. In the over 30 column, 7% of 102,000 is 7,140, and so forth across. They all add up to 42,220. Okay. So the next step, so I want you guys to post to look at those T accounts below and tell me how this looks. So in the AR aging method, the ending balance in the allowance for doubtful accounts has to be equal to the total estimate calculated. In this case, the ending balance in the allowance for doubtful account has to be 42,220. Okay. So what does that look like? So go ahead and put that in, and then I want you to look at your T accounts at the bottom of your page. So down here, this has to be equal to 42,220. So go ahead and write that in your course pack. And your next step.
Wait, can you explain that one more time?
Sure. Do this. So right here, let's back up. We have 620,000 in accounts receivable. Okay. So let's go here. So there you see it. Debit in the T account for accounts receivable, 620,000. Okay. Your beginning balance for bad debt expense is 0. So I just left it blank. Okay. But your beginning balance in the allowance for doubtful account is not 0. It's 17,000 in this case. So that tells us that Garlic Gems, this is not their first year of business. They had some previous activity. Okay, now they're at this year and they're saying, we've estimated we need 42,220 in the allowance for doubtful accounts ending balance. So go ahead and handwrite that in as the ending balance in the allowance for doubtful accounts. And that's going to be on the credit side.
How do you know that it's credit and not debit?
Good question, because allowance for doubtful accounts has a credit balance, and that is our goal, Tegan. So we're saying this is our goal. We're not posting this. We're just saying this is our goal here, to have a credit balance of 42,220. We've created that goal with that spreadsheet, that aging schedule, and now we're saying we have to have that. Now your next step is, what is your journal entry? So look at the top of page 14. That is your journal entry. The question is, what's the dollar amount of your journal entry? Okay. So go to page 17. And you'll see, I can find it here. Yeah, go to page 17. I'm sorry. Yeah, go to page 17 and then create that journal entry that you need. Okay. So bad debt expense, debit, credit, allowance for doubtful account. What is the dollar amount going to be? It's got to be the difference between your goal ending balance and your 17,000. So somebody tell me or put it in the chat what that dollar amount's going to be.
25,220.
Yep. 25,220. Everybody with us? So it's not going to be the full 42,220 because we had an unused balance of 17,000. And now go ahead and post this on page 16 to show the activity. Okay. So now you're posting that journal entry, debit, bad debt expense, credit 25,220, and look, you got your ending balance. It adds up. So that is the percent of AR aging method. All right. So,
Wait,
You
can
guys
you go
ready?
back real quick?
yeah, you got it?
Yeah, I got it.
Okay, thanks, Peter. All right. So we started back here. First, we started with our aging schedule. Then we applied these different percentages, got a total, added up the total, and that becomes our goal, 42,220. And then we said, but we already had a beginning balance of 17,000 credit. So we only needed 25,220 to get our T account to that 42,220 credit. Okay. All right, so now, what if you didn't have a credit balance? What if you had a debit balance? Okay. What if the balance before you make the adjustment is a debit balance in the allowance for doubtful accounts? So just think about that for a sec, okay? And what does it mean? What must have happened to make the balance go to a debit balance? So let's say it's December. The last time you estimated bad debts was the previous December. A whole year has gone by, almost 11, 12 months have gone by. What has happened to cause allowance for doubtful accounts to go debit? Anybody know the answer to that?
Might have been
Yeah.
paid.
Go ahead, Kirat.
Oh, I said it might have been paid off.
Give me an example.
So, the company, like one of the customers who would have owned the money, they would have like come up to the company and be like, we're ready to pay the bill, or we can make a payment this time, and then they might have done some adjustments.
Mhm. That would not cause it to go debit. It would make it go more credit.
Oh,
And-
oh, okay, yeah. There
So-
might have been a refund then.
Nope, that's it. Let's go back. That's why I reviewed these. This is a really an application question, which we all hate, I know, but let me go back on that. So we said the way write-offs work is a customer defaults. They can't pay their bill, okay? And this is what we do. We debit accounts, allowance for doubtful accounts, and we credit accounts receivable. So we've set up an allowance and we're dipping into it and using it up every single time a customer defaults. Okay, so let's say we did it all year long and we're getting ready to make the adjustment for this year. Hang on, let's get up to that slide. And what happens if we look at allowance for doubtful accounts and we've gone into a debit balance? Anybody else? What's happened there? We don't want it to be debit. It's not good. What does it mean when we have a debit balance in allowance for doubtful accounts?
Would that be amount needed to balance out the missing payments? Like say you had,
Close, Chase. It's what it means is all year long. Let's say your beginning balance was 25,000 credit.
okay,
January 1st and December 31st, before you make your final adjustment, it goes into a debit balance. It means you have been writing off invoices from time to time all year long, and your estimate that you made at the beginning of the year wasn't quite enough to cover what actually happened.
okay,
You've been steadily writing up, and it's okay. You're right at the point where you're going to correct that. But let me tell you, if that happens in June, you got to correct it in June, because it means that you do not have enough budget to cover the rest of the year. And this happens during a time of recession, downturn. If your customers have bad managers and the companies are going bankrupt, that can happen. But now when it's time to adjust, you have to take into account that 2,000 to get you to your goal. So let's do another example. I'm not sure I gave you room in your course pack, but if I did, here it is. Okay. Brule has been in business 5 years. The unadjusted balance, trial balance at the end of the year shows accounts receivable, debit 30,000, sales revenue, 180,000, allowance for doubtful accounts, 2,000 debit. Okay, 2,000 debit. Now, sometimes in your homework problems or in real life, we don't do the aging. We just say, we're just going to take 10% of the whole balance in accounts receivable. And this is an example of that. So it's a simpler way of doing the aging. Bad debts are estimated to be 10% of accounts receivable. So how much should the ending balance, your goal for allowance for doubtful accounts, be in this case? What's your goal here?
is it $3,000?
How did you get that?
Just 10% of the accounts receivable.
Correct. Okay. So our goal is 3,000 credit in allowance for doubtful account, but we have a beginning balance of 2,000. Our ending balance goal is credit 3,000. So what's our journal entry going to be?
1,000?
So if we credit allowance for doubtful accounts 1,000, will that get us to 3,000?
Would it be 5,000 then?
It will be 5,000. Yeah.
Yeah, sorry.
No worries. Everybody does that stuff. Okay. So you have, using the AR aging method, the percent of AR method, you always have to consider the beginning balance. And then you make the adjusting entry to match your goal. Your goal is 6,000, or your goal is 3,000, but you had a beginning balance of a 2,000 debit. Okay. All right. Okay. All right, percent of sales method is so easy by comparison. You literally make the journal entry based on a percent of sales. You disregard any balance in allowance for doubtful accounts. Okay, so this is super simple. Once you make the calculation, that's your dollar amount. This method, again, is not discussed in your book, so just be aware of that. Okay, all right. So this is, I believe, on page 17. On June 30, assume that Martinez Company had monthly net credit sales of 2,400,000. Did I say credit sales over here? No, it doesn't say that, but it's understood that this is only applied to credit sales. Okay. In other words, if you are a company like Nordstrom and part of your sales are cash and part of your sales are credit, you only apply the percent to your credit sales, because you've already collected your cash sales. Okay, so Martinez had monthly credit sales of 2,400,000 and it's net. So let's say they had sales discounts and sales returns. You want that net sales number, not the gross number. And it estimates that 2% of these credit sales will be uncollectible. You already know the journal entry, debit bad debt expense, credit allowance for doubtful accounts. We are estimating bad debts. What's the dollar amount? What's the actual dollar amount? You can put it in the chat or you can put it, you can call it out.
Would it be 48,000?
Would be, yeah, thank you. So debit, so write that one down. Debit bad debt expense, 48, credit ADA, allowance for doubtful accounts, 48,000. I didn't have to look at any beginning balances. It's the percent of net credit sales method. That's all I have to do. Did I get that one? Where did it go? Let's see, I'm here. Oh, I jumped ahead. Okay, hang on. Okay, now we are going to take a look at more detail on this aging schedule. So you've learned both methods, and I want to give you a little more insight into this. So we're going to look at page 18. You've got this invoice on that page, and it's a little bit hard to read, so just bear with it. And we're going to look at what all this means. So, because we're kind of learning this in kind of a theory base. 18. All right. So here's just an ordinary invoice. The company who sold this item, mulching lawnmower, the company who sold it is Whitehall Robbins. The customer is Kim. The dollar amount is 20,000. And the invoice date is December 5th, 2011. Okay. From here, and you can see this list at the top of page 19. So let's assume Whitehall Robbins has a total of 39,600 in what we would call open invoices. They have not been paid yet. Okay. Open invoices add up to 39,600. So go down to the bottom of your page and log that in accounts receivable as a beginning balance or starting balance that we're working with.
Page 17.
Is it page 17? It should be
Not
19, 19, I believe.
19. Okay.
Yeah. Okay. All right, everybody there? So you've got that beginning balance, 39,500. And we're not going to take the time to create this schedule invoice by invoice, but I want you to understand how it works. And if you have questions, you can come back and look at this. So let's look at the middle of the page. I mean, it says prepare an accounts receivable aging schedule using the attached schedule in alphabetical order by customer. We're obviously not going to take the time to do that. But what I do want you to do is note that post the beginning balance of accounts receivable in the T account. You've already done that. Post 0 beginning balance for the other accounts. Okay, we're going to have a 0 beginning balance for bad debt expense and for allowance for doubtful accounts. So be sure to do that. Okay. So I went ahead and created an aging schedule. So I looked at Absolar. So that's one customer, okay, $600. So let's go compare that to your list. Absolar had 3 invoices. One was November dated 300, one was September dated 200, and one was August. So this is like a summary by customer. The customer owes Whitehall $600, and it's split up into none of it's current. Absolar has 300, 1 to 30 days past due, $200, 61 to 90 days past due, and $100, 90 or more days past due. So you have to kind of ask yourself, why are we selling? Why is Whitehall selling to this customer who doesn't seem to want to pay their bills? On the other hand, Bowman here, Bowman has 1 invoice and it's current. Okay. Kai has 2 invoices from November and October and so forth. And here's that Kim invoice that we looked at, 20,000 in December. Okay, so come down here, you see Kim, not yet due. That means it's in December. Now, I wrote these months at the top. Typically, you don't see those, but essentially, the accounts receivable aging report, and it should have a title up here, say Whitehall Robbins. As of December 31st, any invoice dated December is current, not yet due. Any invoice dated November is 1 to 30 days past due and so forth. Okay. So what I do want you to do is on page 20, I want you to go to that total line. You don't have to fill all this in, but go to the total line and write these totals down. That's what the aging schedule adds up to. Okay. So I'm going to have you do the calculations on this, and you're going to use those totals and you're going to apply those percentages that are on the middle of your previous page. Okay. So write down the totals first, and then we're going to apply the percents.
I have one question.
Sure.
On page 19, all of the like dates and amounts and just the way it's organized is different than on your slide, like on my force pack.
Here?
Yeah. It's
Yeah, you
completely
know
different.
why? I put it in there as scrambled to make it harder, but I don't think we want to do that. So it's the same data. It's just I put it in alpha order. So
Oh, okay.
So does anybody need more time?
Yeah, me.
Okay. No worries. Yeah, Micah, I was working on this Friday and I thought I'll just leave it as I'll clean it up a little bit. Typically in a homework or test problem, they might be scrambled. And the idea is that you would be able to put them in the proper order. Okay. All good? So just that total line there. Okay.
Almost.
All right.
I'm good.
Thank you. All right. So now you're going to apply these percents. Write down these percents underneath those dollar amounts and then multiply them out. So in the first column under not yet due, you're going to write 2%. In the next column, you're going to write 4%, 10, 20, 40. And then take a minute, do the math, and tell me what the total is going to be for that. And remember, we are doing the AR, the percent of AR method, not the percent of sales method.
So would the 2% be applied to the 2,700?
27,000?
Yeah. Sorry.
Yeah, the 2% would be applied to the 27,000, and then you
Okay.
just keep going over. Yeah, good.
Can you go back to the percentages?
I have to tell you, they turned our gas off today to do some work, so I might get interrupted early, but hopefully not yet. It's weird working from home sometimes. You have to answer the door. At least when it's your power company, you do. All right. So what have you guys got? What's your total? Actually direct message me that. Don't call it out. Direct message me your total. What's our estimated bad debts? Helena, you are correct. Anybody else? Annie, you are correct. Alexis, no. Brienne, yes. Not sure how you got that, Alexis. How'd you get that number? So,
Well, I just did the percentages for each one. Maybe I
Okay.
just put them in.
yeah,
the
just double
column.
check your math. This is
Yeah.
one of those accounting problems that's super easy to
Yeah,
mess
I
up.
see where I did wrong.
All right. Okay. All right, so we're getting that. So let's just look at the answer here. So we applied the percents here. And if you didn't get these totals, so just be aware when you see these problems to double check your math twice, or double check your math so we have a better sense of where we are. Okay, so if you didn't get those answers, go ahead and change them out. Okay. All right. So now turn the page back and write in your journal entry. What is your journal entry going to be? Okay. So you had already written in these totals, but what are you going to put for a journal entry? What's your debit? What's your credit?
Would it be credited for the bad debt expense 2228?
It will be, but it'll be debit. Debit, bad
Okay.
debt expense, and then what's the credit?
Would it be accounts receivable?
No. Remember when we estimate bad debts, I said, put your beginning balance as
no.
zeros. So when we use this method, when we use the estimated bad debts, I'm sorry, when we use the percent of AR method for estimating bad debts, This is our goal. Your percent total is your goal for what your ending balance and allowance for doubtful accounts needs to be. So we said, here's where we started. When we estimate bad debts, it's the same journal entry every time. Debit, bad debt expense, credit, allowance for doubtful accounts. So you're going to book debit, credit, and then log your journal entry there. So Julie, correct. Yeah. So write your journal entry and post that journal entry to the T accounts on the bottom of page 19. Okay. All right. Okay. Do you guys need more time? Are you good?
Sorry, I'm still trying to figure all this stuff out. It's
Sure.
like trying to send you a message personally. I'm like, I don't know. I can't like just pick up stuff like that, especially with
No worry.
online.
That's why we're doing it on the course spec. So let's back up. Let's summarize. So we started off with way back with Garlic Jim. I'm just going to back up. Garlic Jim had 620,000 in accounts receivable, and they estimated 442,220. They did it by creating this aging schedule, and this is just the total. Okay. And for each column, the risk gets higher. The older an invoice is, the more likely it is not to be paid ever. And that's why that percent goes up as you sort of march across the aging schedule. Still an estimate. I mean, your customers could surprise you. They could all pay you on at some point, but the company has to be conservative. They have to estimate the bad news in advance. They have to plan for it and create this allowance account.
So you're
Hey, real
adding all
quick.
those numbers together, basically.
Say again?
You're like adding all those numbers.
Yes,
like
17 plus
okay.
9 plus 7 plus 9 equals 42,220. So we're saying that's to the best of our ability, that's the worst case scenario. Okay. Not
Real
even the
quick.
worst case. That's probably the average case scenario.
Is there a certain percentage you're supposed to use for the total to find that number?
The companies have to create their own percentages based on their own history. So they would say, typically we track this stuff. Typically, if it hits over 90, our chances are 50%. You know, in the last 2 years, anything that went over 90, we only collected 50%. So they have to keep their own data. Okay. And when companies estimate, there is so many opportunities for fraud and data manipulation. Okay, I'm just going to put that out there. Okay, so then I said, let's practice that again. Let's look at a different company, not Garlic Jim's. Let's look at Whitehall Robbins. This is an example of an invoice. The aging data is based on customer invoices. Here's that Kim invoice, 20,000. But we have to take all of our accounts receivable, the 39,600, and we have to age it. And so I did that for you, and I asked you to list that at the bottom in the total line on page 20. Okay, so all of these add up to 39,000. Okay, then I said apply these percentages to these totals, and you're going to get a whole bunch of numbers, add them up, and it adds up to 2228. So that's not as bad as 42,000. That's a lot lower, but it depends on your business. I mean, you could have customers that are not usually defaulting. You could have customers that have a higher rate of defaulting. It depends on your business. So, and how much risk as a company you want to take. Okay. So we had that 2228. In this example, our beginning balance was 0, so we did not need to take that into account. We didn't need to adjust anything. We just took the dollar amount, debit bad debt expense, credit allowance for doubtful accounts. Okay. All right.
Would I be able to copy the those T accounts real quick, just so I can like understand the concept?
Absolutely, yep, and put them in your, on, at the bottom of page 19. So a couple questions you always want to ask is you've done the calculations, you've checked your numbers. You always want to ask, what is the beginning balance in the allowance for doubtful accounts? Because when we use the AR method, the accounts percent of AR method, you have to take into that account. Because when you're done, it has to equal your estimate if you use percent of AR method. All right, let's look at, I think we're ready for a break. Let's see. Do this. This is page 21. Okay. All right, let's take a 10-minute break. I'm going to check your Cornelian window washing, and I'm going to, I don't see Claire, so I'm thinking she might be coming on Wednesday. So. All right, okay, let's take a 10-minute break, and I will see you guys back at 11:31. So.